Good morning, everybody. Welcome to the Flow Show. Here we are, very important day in the UK. The autumn statement, where everyone gets to find out how much money was found on the magic money tree that suddenly sprouted growth down the bottom of the Chancellor's garden. If you don't want to stick around for the TV showing, for the live feed, it's all over Twitter anyway. So we know most of what's likely to come. So no real shocks to happen from that one. Anyway, plenty to get stuck into for the rest of the day. Morning, K-Man.
Hey, good morning, Ryan. Good morning, everybody. Is it autumn? Oh yeah, it's actually a pretty sunny day outside today. So
Is it?
must be a good day for the sterling.
Oh yeah, look, there's the sun. I've just looked out the window, just opened my curtains. There's the window. There's the sun, just peeking through. Bloody cold though, and yeah, made into a cold spell.
Must have all to do with the statement, you know.
Yeah, probably. But yeah, crank that heating up. We're going to have a cold one this weekend. Our first cold snap.
Absolutely.
And, everyone's going to be burning the matches at both ends this weekend. Right. Anyway, let's get down to the important stuff. Over in China, and the Chinese government advisors have recommended a growth target of 4.5 to 5.5% for next year. That keeps things there or thereabouts where they like to keep their growth forecasts for the year. However, they said that maintaining the pace of growth next year will require more fiscal stimulus. Obviously, part and parcel of that is going into the property market. At the moment, Country Gardens, one of the ones on the list for this extra help, let's call it that, from Chinese authorities. That was announced overnight as well. So still a lot of propping up needed, according to the government advisors over there. Just looking at the fix in China, keep an eye on this one because we've had a big move. It's probably more important to keep an eye on these fixes now than it was when we were doing nothing for a few months up here, because it can give you an indication whether they going to allow this move to continue or whether they feel it's gone far enough. For now, it looks like they're happy to continue to let it go. They fixed at 7.1254, 7.1254 versus 7.1406 previously. So it seems they want to keep pushing on the open door, shall we say. Not quite ready to put any roadblocks in front of the move currently that we've seen. Still got that big zone down here, the big support zone down here, and maybe we can call that the first test. I don't know. We shall wait and see. We are trying to knock on the underside of this area this morning. If that holds, then that might keep the pressure on and we get a further test at that level. But for now, as I say, Chinese authorities happy to keep pushing the narrative for further yuan strength. Excuse me. Over in Japan, the Cabinet Office cut its view for the Japanese economy for the first time since January, in fact. So nearly a year they got through without cutting the economic forecasts or the overview. And they said that the economy is recovering moderately, but have noted that some areas have stalled recently. It cuts its view on capex for the first time since December 2021. Sees the pace of pickup in capital spending is looking like it's pausing. So a bit of a downgrade there to from the Japanese government, what they think is going on in the economy, which is, I would say, pretty much what we've seen. We've seen some area, obviously manufacturing's in a bit of a slump, like a lot of economies. Services have been so-so. It seems like the wage rises thus far aren't triggering a huge amount of spending or activity, but that's a slow snowball rolling. What did you make of that news last night, Kay?
Yeah, as you say, it's been a bit on and off in the data. They've been good for a few months, and then yeah, the issue is the capex. The issue is the real wages, and with this, like, a little bit of a downgrade or the expectations, it does put more emphasis again on those wages, right? And I reckon that's the reaction that we have seen, at least throughout the Japanese session on the yen today. We are still in the same, how should I say, in the same big picture, but we every time there is something that tells us, oh, it's not going to go as fast as people may hope, and this is another bit of a setback. So that is really telling us we are going to have to watch. Oh, well, likely nothing else than those wages coming up in the spring, unless we get like a real surprise at the last meeting of this calendar year from the BOJ. But that does look to me that doesn't spell anything really good still for a long-lasting yen recovery. If they, after a string of better reports and even a bit of upgrades, they have to downgrade it again straight away, the outlook after the prior upgrade.
Yeah, and maybe a bit of a wake-up call for yen traders. We know that a lot of this was a dollar move in particular, plus a bit of hopium over the BOJ, but then you get something like that dropping and everyone remembers that it is going to be a slow road and they're not out the woods just yet. But quite a strong move for that. So I think there's a few things going on in the dollar and the yen pairs. But
yeah, really what I think is that we've seen a big round of take profit. You know, the yen was lagging on everything because of the yen crosses being so high as well. And I guess on those, as we've been saying, the whole package of the US data slowing just that bit, the yields coming off a bit, the yen was really lagging. And then probably some big accounts decided to take profit on parts of their position, and they sucked some poor traders into it, trying to push it lower, and that again exploded in their face.
Yeah, very much so. Because you can tell if we're getting a big shift, like a big fundamental shift in rate pricing or something like that, or even BOJ pricing, you don't get such big turnaround moves like that. You would get it up a bit, and then the rallies get hit, and then it gets sold again. But to have quite a sharp turnaround,
it's too sharp.
Yeah, quite some flow going on here.
Yeah, what I also reckon, and I showed it, that daily cloud on the dollar yen, which was hanging around 148.5. That was like roughly the opening price yesterday morning, and then they pushed it further down, and then but as soon as it came back inside, the Japanese started to short cover again. So yeah, I don't think we can. I don't think we can say the yen is yet there for a lasting recovery. Of course, the dollar has recovered a little bit as well, but if you look at the yen crosses, they're all higher, right?
Yeah, exactly. But I mean, I wouldn't dare suggest we're going all the way back up to 152. I think there's probably enough in the pipe on the dollar side for the dollar not to be bought as aggressively. So we shall see. I'll give you three guesses what level I'm watching, and everyone can know it is the big fat red line there at 150. That's still going to be my marker, much like 147 was down below. So if we do get a bit of a shift up when US comes in, we'll see how that behaves. I might have a little think about a short up there into 150, but nothing that I'll be trying to sit on for too long if it doesn't go my way. Right, anyway, moving on. RBA's Bullock was out again this morning, saying that more substantial tightening is the correct policy response. The RBA is still seeking to tread a narrow path on policy, and saying that the inflation challenge is now more homegrown and demand driven. So it gives you an idea that we need to keep an eye on the core numbers coming out of Australia regarding inflation. Over to Miss Sunbed, and Lagarde says we have made these future decisions conditional on the incoming data, meaning that we can act again if we see the risks of missing our inflation target. That's a warning to all those trying to price in cuts. Given the scale of our policy adjustment, we can now allow some time for them to unfold. but this is not the time to start declaring victory. ECB Schnabel says longer-term inflation expectations still signal risks, and one of the big doves says that inflation is falling. This is ECB Centino. Inflation is falling faster than it rose, and there's a high probability we've reached peak rate, which that's a little bit of a concession to the hawkish side, because he was telling everyone that we have peaked in rates. So higher probability is not we have. So just a subtle change there, not that it means much for the euro, but it just shows you that they're not willing to let go just yet. In geopolitics and what's going on, the iron rod of the EU, they out with some guidance, and or the EU Commission was out some guidance on various countries. They say France risks breaching their fiscal guidance rules, as we mentioned earlier this week, yesterday, I think. They say the Italian government needs to exercise fiscal prudence, and that Germany must phase out energy support measures. Speaking of the Germans, the German government has blocked the use of the Economic Stabilization Fund, the ESF. This is on the back of that constitutional court ruling that they can't move pandemic funds over to green policies. So the government has now effectively stopped all spending other than budget spending that's been earmarked. There's no other spending happening until they sort this mess out. I don't think it's going to impact too much, as I say, because this is spending that's already earmarked is still going to go ahead. But anything on top, so if they need to do further energy price support measures or anything like that, on top of what they're all currently doing, apparently it's all been blocked up. What are you making of that, Kay? Do we need to worry about it, or is it just a bit of a storm in a teacup? We just sit here with our fingers in our ears.
I'm a little bit in between thoughts there on that one. On the one hand, coming back to that German thing, apparently it's not going to be a whole of 60 billion, but 30 billion euros, and I'm tempted to say what's 30 billion euros amongst friends when you do a budget of those sizes. But I would like to take it in conjunction as well with what the ECB is doing, where putting like 20 of the major European banks on watch in regards to green and everything. And what it tells me is that Europe is still not out of the woods concerning budgets, realignment of thoughts, and even money in the whole of the eurozone. And I'm not going to say that the market is going to trade it, but it's just one of those things that keeps overhanging, and it's a bit of a dark cloud over it, where you can say that at times, if the markets want to trade it, and if you get fiscal issues in some of the major eurozone countries, and then on top of that, their banks getting slapped on the fingers as well, it might at times weigh a little bit. But on the other hand, it's also something that maybe the European bond markets may think about, because who says like more reserves, more capital needed here and there probably means more borrowing. So that may actually keep a bit of stress on or a little bit of a underpinning those yields, and weighing on the bond markets in Europe as well.
Yeah, it might be one of these minor things to watch out for next year.
Yeah, recall Italy, right? When there was the issues in Italy, it wasn't really traded every day, and so, but then the euro was a little bit under pressure because those spreads with Italy, Spain, Portugal were stretched, and it created a bit of a cloud where the euro had difficulties to recover during better days even. So it may become something of the likes, but it's likely going to be a case for, and it's going to be long spun out, right?
Yeah, exactly. As I mentioned yesterday, it's going to be a bun fight between the rule makers and the rule breakers, let's call them that, i.e. the countries. They've had this free leash with the pandemic stuff, and previous to that, now the bills have got to be paid, the rules have got to be respective, and the EU is going to start getting tough on countries that don't come within their budget rules and the like, which, as cases, can create a bit of tension for investors. If countries need to borrow a lot more, putting pressure on yields. It didn't matter, 4 or 5 years ago when everyone's yield was 1-2%. Now they're much higher. So, you see Italy or someone blowing out to 6-7% on these worries. It's going to create potential waves. Then that gets the rating agencies involved,
Yeah.
and that brings the downgrades, and then investors can't hold that debt, and so on and so forth. It's not something you can sit here now and go, "Oh, I'm selling the euro on that risk," but it's going to be one of those things that's going to be potentially bubbling along under the surface next year, that could, have an impact on a lot of markets.
Yeah.
So
Yeah.
we will.
Yeah,
Yeah,
and also what I've been saying as well is that if and as you just said, Ryan, if your rates are zero and everybody's pumping money in the system, you don't see it. But if the rates are higher or high like they are now, we have seen that sometimes those small things can make the markets move quite a bit when a headline strikes. Then you all of a sudden do those 20-30 bps in the 5-year or the 10-year or whatever, and everybody is wondering what's happening. Well, those kind of things can now happen because we have seen those kind of moves once we start to have less certainty. For instance, the US 10 years as one example, 5%. People are starting to think, oh, the data are starting to change. Big guys are starting to take profit on short bonds, and then all of a sudden you do 60 bps to one side on US 10s, which is a huge move.
yeah.
Well, that is something on those headlines next year or so, which may happen during some days, just more volatility.
Exactly. A 10% move in bond yield when your yield is 1% is one thing. A 10% move on bond yield when your yield is 4.5% is a completely different thing, and that's a lot of beans for governments to soak up. But anyway, one for 2024. Let's get this year out of the way first before we start worrying too much about that. But it's on our radar. As we say. Right, let's have a quick look at some of the data from yesterday. Slipping under the radar, as it often does, the US Philly Fed Services report, not usually on any calendars. I completely missed it yesterday myself. But that came in at minus 11 versus a prior minus 20.3. So a bit of an improvement, or not as crap as it was. New orders also less of a negative, down 8.6 versus minus 16.1 previously. Prices paid, that all important inflationary number, came in at 40.6 versus 46.6 previously. Unemployment jumped up a bit to 14.7 from 8.2, but wages and benefit costs came in at 32.8 from 34.2, so a bit less than expected there. Excuse me. What was on the calendar was Canada CPI numbers, which pretty much confirmed the drop in CPI. Headline CPI doing a bit better, 3.1 versus 3.2 expected, but confirming the drop from 3.8. The odds and sods core measures also, some coming in a little bit softer. That one there, 3.5 versus 3.6 expected. That one there came in as expected, 3.6. That one there came in at a little bit softer, 4.2, all dipping from last month. And the BOC's core number coming in a pit down at 2.7%. So going the right way for the BOC. No need for them to get a hawkish wiggle on again into the latter part of the year. Home sales, existing home sales. Again, it's been a bit mixed so far this month from the let's call it the hard data. This is all from October. So we saw starts and permits doing pretty well. Existing home sales were a little bit softer, down 4.1% to 3.79 million, missing expectations and much lower than last month. So one data print up, one data print down. End result, who knows what's going on there. We also got the Fed minutes overnight as well. Not too much from that, really emphasising the pushing the higher for longer message. Rates will stay restrictive for some time. There may be more tightening if the progress on inflation is insufficient. But for now, they're going to proceed carefully with rates. So pretty much no news there from what we didn't know. Anything in that you picked out? Okay.
Yeah, I just wanted to say we were right. Complete non-event.
Good. I love it when we're right.
Huh?
I love it when we're right.
Yeah, data dependent, cautious, restrictive, whatever. I mean, yeah, all the blah, blah, blah we heard a dozen times from each of the Fed commentators. Same thing that you were saying with Lagarde earlier. It's just, I mean, the same thing. They're just all data dependent, and so are we, as we said already after the last round of meetings. We are all now data dependent, and that's it. Nothing new.
Yeah, exactly. But there is some new forecasts from the banks who like to jiggle their counters around the board after such things. With the Fed, Barclays have ruled out a January hike now, and they see rates staying unchanged until December 2024. So they were expecting a hike in January. That's off the table, and no further hikes seen for the rest of the year. For the Bank of England, JP Morgan now see 50 bips of cuts in Q4 2024, whereas previously they saw the BOE holding rates throughout the year. So they're jumping on the cut bandwagon, but that's pushed well out to the part of last year. I'll give you 3 guesses that won't stay there, and they'll be pulling those forward over the next few months. You can take that to the bank if you like. No Fed heads yesterday that I could find anyway, so that was good news. So yeah, the autumn statement's coming up. As I said, we know what's going on. The stuff that's been out. I'll just go and find it actually. Let's have a quick look. So they're going to be cutting national insurance. Apparently, this is what we pay in as a sort of tax to fund the NHS and that sort of thing. They're going to be making, they've got a tax break for firms on what's called full expensing and things like declaring investment and the like. They're going to make that permanent. That was due to expire. They're upgrading benefits by 6.7%, upgrading the state pension supposedly by 8.5%. The living wage, which is the minimum wage as it's called here, is going up as well. And they're going to raise the VAT threshold for businesses. That's according to all the latest leaks and whatnot. So on the face of it, it all sounds like positive news, putting more money in people's pockets, giving some good incentives to business. That might be why we're seeing the quid reasonably supported today, not doing as much damage versus the dollar as maybe we've seen in euro dollar. But of course, this is all going to come out with a fanfare, then it'll all get shot down in flames by the opposition, the bean counters and the rest of it. So still not thinking that we're going to see any big moves in the quid unless something pops up that we haven't heard. But as usual, we have most of it leaked out already. Right, so yeah, go on,
Ryan, come on. I mean, you should be positive sterling. Who was it? Sunak or Hunt said that he wants to make he wants to rebuild London into the next Silicon Valley. Come on. I mean, we should all be long sterling to our eyeballs because of that. You know, it's going to be summer all year in London. New microclimate. Nobody pays taxes.
Most people in London would just be happy to get a tube that's not on strike these days. They're like bloody Silicon Valley, or even get a seat on a tube. Anyway, yeah, let them. That's what it's going to be.
Yeah, I think that's it. You know, we spoke about that. We wondered whether it's going to change a lot. I think we've seen a little bit of the market front running this statement as the information came in. The key probably for markets being if they go for permanent VAT cuts or hiring those high ceilings. So that's where the market takes the positives from, and dare I say, perhaps the positives are already nearly in.
Yeah. I guess the other positive is that we're unlikely to see the type of blowout we saw after last year's
that's true.
statement, the Liz Truss stuff, which was a complete load of crap in itself. Everyone's still blaming Liz Truss for that move, but it wasn't her at all. It was an excuse used to get the pension funds a little bit upset and hot round the collar. That's what did all the damage. But anyway, that was then. This is now. If the IMF pipe up about this one, they can go and shove it up their backsides. Anyway, let's move on, shall we, before I start getting really ranty. Right, so as we were saying, bit of a move in dollar yen this morning. Really a sharp rebound here. It's running into a bit of trouble up here. Around the 149.30s. We're now just seeing a move back under 149, so maybe we're going to see a little bit of choppiness coming into this one. Anyone who's been buying up here won't be sitting in it long if it doesn't keep going. But I think we might get a further capitulation of some of the players who might be short in this move if we do get a break above 150. So as I said, I'm going to be watching that as the US lot come to town, their final day before they go for their practice Christmas. Euro dollar has moved back down through the levels. We were talking in the room yesterday. It just felt like it was, and a lot of Euro pairs just huffing and puffing up around here yesterday. Not cracking on through the highs, holding the support, but then as soon as that support broke, it's been a bit of a domino effect. We went through there and that 109.40, gone back through the 109.10, 109s, and now we're finding resistance against that 109.10. So looking a little bit more bearish. I won't be surprised if we get a move down to this zone, and then we see if it acts a bit sticky again, a bit of traffic like it did through here. This is an age-old zone, this one. Almost important as the 107 level for its history, but it's a bit of a traffic area that I keep an eye on. So yeah, we're looking a bit softer today. If we're going to break this whole rally though, we need to be back under 108.30 and then probably the big figure 108. Then things will look a little bit more bearish. But for now, while we're staying up around these levels, it's not doing too much damage, but we'll wait and see what the rest of the day does. Euro sterling as well. Speaking yesterday on this one, didn't hold the 87, 1720 area. We're just mooching around in this sort of zone again. 86.90 looks to be the line in the sand again. When we've gone below there, we have tended to have a bit of a steeper fall. But for now, we're just keeping our nose above it. But this one again, just it makes you pull your hair out. Those that have hair, sometimes, been waiting in this area for this breakup. It hasn't happened. Now we're seeing a bit of a pullback. Is it going to do more, or are we just going to bump along and go sideways again, and then maybe spend a few months going between the levels here or there? Aussie's looking a bit more confident this morning. Let's call it that. Well, look. Comments could have been construed a little bit on the hawkish side, depending on how you viewed them. But the Aussie seems to be doing a bit better again this morning. The Kiwi was outpacing earlier in the week, but now the Aussie seems to be jumping up a bit. You see anything coming out for this one? I haven't checked. Obviously, gold's still sitting up at 2,000, so comods aren't doing overly bad. Any main reason for this one to bounce, mate? Particularly, was it
Yeah,
Kiwi?
I think there's okay. There was a bit. There's a bit of the Aussie Kiwi. Yeah, we had this setback. I was a bit surprised by it because I was long from that 108.15 the other day and stopped out the rest through 45. But 108.15 is still showing up, and I somewhere there's logic in this move. Backup, I would say. Also, because Bullock, sometimes she does, and then other times maybe a bit less. But then when she spoke again overnight, she does seem to confirm that she's a bit more hawkish than Low ever was. And still leaving the door open, perhaps even more than some other central banks. And yeah, I think she's she's doing an okay job to keep the Aussie up. If the dollar would get an extra knock on the head, perhaps I'm not saying it will, but perhaps if it gets another knock on the head into month end or so, or if risk remains positive, I wouldn't be surprised if Aussie dollar would be one of the main beneficiaries of it.
Yeah, exactly. But for now, I mean, technically, it's doing okay. All right, it's bumped its head.
It's doing
hello?
very okay. Because we had those two confirmations. You
Yeah.
broke out that first trend line above 64.5, and then the prior 65.20.25, which has always capped the debates up to earlier, is now likely going to come in as a very decent support.
Yeah, so a bit of a better ground here between there and this fib and this high area, 65.80 odd. So that's your better ground, and you can probably swing one way or another. If you get a decent break above here, then we're probably 66 bound, and there's obviously plenty of traffic in the way as well there as you get up to the 61.8 fib of that move there. So yeah, if you're not long, you know where to try longs, and if you want to go short, you know where to try shorts, and you know where you're wrong in either case. Yeah, as mentioned, dollar China. Again, doing what it needs to do technically. I'm going to call this a half test of this area down here. We didn't quite get down there, but you know we've had various stall points around this area. So the battleground for here, we're holding below the bottom of this zone, which could be significant. Stay below there, keeps this pressure in. It hasn't bounced back as strongly as say dollar yen has, which was a bit of a surprise. I thought if there was going to be a bounce in the dollar, we would see a bit of a stronger push up, but we haven't. So yeah, that keeps this move in play for now, but we still need a break below that level there. Just gold, Mick, before I hand it over to Kay, just a quick look at gold, because this one's still hanging around up the top. I'm in a little short up here, 99s. Oh, excuse me. Shut that off. 99s and 06. It's not coming back. We've got this intraday break point round about the 90, 95, that sort of area. It held overnight. It's coming a bit shorter, so you can see that. It's pretty much held this break of this area overnight, which is not good news for my shorts. But we're not attacking the highs entirely. But I think if I had to pick a side, I'd say it's more likely this is going up than going down. And that'll be the case until we get under this 95 and then more importantly, 85, 86 area down there. So that remains a bit bullish. As does oil, still keeping its gains off the bounce. Similar move to dollar yen, really. We had that big flap out and then a steep reversal, and now it's holding going sideways. So again, a bit of support for the commodity lot as well. Kate, do you want to have a little look around?
Yeah, I can.
All yours,
Alrighty,
mate.
let's first have a look at those yields, shall we? And take this US 10s as an example. There is a bit of expiries and renewal of contracts and rollovers and everything to be done on a lot of the treasury contracts into the end of the month. And before I look at it at anything more in depth, I just want to say we can be in for quite a volatile end of month, and also looking at Thanksgiving coming in between tomorrow in the US, and then we have another 4 days next week into the end of month. I am thinking that looking also at where equity markets are trading, we may be in for a bit of volatility. So whether it's going to take a clear direction on the FX remains to be seen. And I just wanted to warn that we could see some breaks of certain levels into the end of month, but perhaps those breaks will not be sustained once all those expiries and rolls are done. So be a bit careful with, I'd say between now, because it's the day before Thanksgiving, then on Black Friday, there's going to be a part of the US market which probably the market players will just stay at home, and then we getting into the end of the month next week. So from now on, I would say, perhaps especially in the US market time, because of those rolls and stuff, be a bit careful for the moves. But anyway, US tens trying to recover this broken trend line, but it's already offered around 445, 46, 47 on the US 10s, and we are slowly sliding back. Okay, we're still watching this 33, 36 area, but again, I'm not sure whether those rolls and things may create extra volatility, may even see a dip below and then all of a sudden take it back once the rolls are done. So be a bit careful with what's happening here. Anyway, I guess if we would start to break below, there's going to be a bit of dollar selling going through. And actually, if you then look at what's happening on the dollar yen, it was really rebounding. And let me first go on to, and this is something I normally don't do, but I'm going to go on to the shorter time frame first to show this move, which Ryan already showed as well. So we saw the sharp move up, and then look at what's happened over the past hour or so. It was all looking very rosy or very short covering and everything in the dollar yen, and we've already lost 60 pips again. That is because those 10 years now have slipped back sub 440 and are actually slipping a little bit again as we speak. So this is what I'm saying. It's going to get, I reckon, this volatility may be staying for a while. If you want to look at what should happen on closures and things, or if you want to have a measurement on where strength of weakness may lie around the close of the day, keep an eye on that daily cloud today. The top of the cloud is at 148.80, 82. So we are really close, okay? And as we've been saying already a lot of times, the Japanese market is looking at it. And also the recovery, look where it's stalled. It's stalled at the, today, it's stalled at the 55 DMA again. We also saw this stopping here, and when it broke during the acceleration, and we stopped here at the 55 DMA as well. So keep an eye on that 149.30, 35 zone perhaps. And keep this as perhaps a measurement of strength or weakness of the dollar as the day comes to a close or going into Thanksgiving also. Yeah, the bottom side, not a lot really. I mean, it's been so violent, but if you want to have an intermediate level, I'd say 148 the figure, 147.90, and then that prior low 147 before the bigger zone here, which I think still lies around 146. Let's say. Yeah, euro dollar. It looks as if we're trading along this line here, and I was a bit short yesterday, and I must say I didn't really. I bought some. Well, I bought a fair bit back above this, just above this trend line, but I didn't see this move happening. I was out of the office when it happened, but it does look as if we're starting to find bids under 109, 108.90. Okay, so this is basically 109, the figure right now, and keep it an extra little level here around 108.80. And that should be your intraday support. Again, I think perhaps more volatile than picking a direction. The big zone is still 109, 40, 60. Had a couple of pips above here yesterday, but nothing really to panic over right now. But if we start to retest this and get a close above this level, or really just going through, I reckon that there might be a bit of a round of stops going off. Again, I agree with Ryan on the underside of the zone here, 108 and a quarter to 108.40. That's the going to be a more serious support zone now. We have seen 1, 2, 3, 4 tries to get below, and then the move higher again. Okay, so this is to me the major zone right now. If you look at this one, this is going to explain why also why cable is better bid and the euro and the sterling is better bid. The EU differentials versus the dollar are still stuck, but this one moved up a little bit. I do reckon that it has to do a little bit with people being hopeful or confident, or however you want to call it, in let's say more hopeful for the UK outlook for those corporate tax reliefs and stuff. So that's what's going on right now. What's keeping the sterling up? Have a look at what's happening with this throughout the day or even tomorrow to see if it can hold, to see if the sterling can hold its bid side. I want to look, and we were talking about this. I want to have a look at this Aussie. And this is dollar cat. Dollar cat yesterday, CPI, non-event, bit of up and down. But I think for as long as we're above this 136, 40, 65 zone, it's still oriented to the top, but I wouldn't be surprised if we test it sooner rather than later. I wanted to show you two things, the Aussie and the Kiwi. So the Aussie is holding this 65 and a quarter zone, and that's also what we spoke about, what I spoke about yesterday, this 50%. The major resistance to me lies around 66.5 to 66.80. And you know what? I think if there's more positives coming from equity markets, or if dollar China caps, if the dollar finds a bit of resistance, this to me is a candidate to go, perhaps even before the month is over, to go and have a test perhaps up there. For that, it has to hold this 2025, and that's going to be key, I think, right now. Kiwi is looking a bit opposite right now. We've broken above this trend line, we've broken above the prior double top, and then it looks like a failure, but we are creeping slowly up to the zone again. So I'd say still watch 55.60 on the Kiwi dollar, okay, to decide upon further moves. Love to have Giuseppe. Love to have cat strengthened to enter a sell on a dollar cat pair, or on a Canadian dollar pair. What do you mean? And then I want to this zone that we were talking about on already a couple of times. This traffic area in the S&P. It's continuously forming like what you can call like small flags and small I don't know, pennants also, whatever the specialists may call it. But yesterday I was looking at it this 45 and a quarter. zone, we went to test it on the S&P, and it's already enough. Those are really very shallow retracements. I think we really need to start to get below 45.25 here, and then hold, cap it, to have a chance to get back to other levels. But if you look at this looks like it should retrace at some stage, but it isn't. So that is telling me that, I don't know, but perhaps into the end of the month, are we not going to see this 4,600, right? Yeah, we're seeing bank calls as well now, already calling for 5,000 next year. So let's see what happens there. There's a lot of hope on the Goldilocks scenario still. I don't know at this point, but it does look still very big to me, for as long as it stays above 45.25. I don't trade DAX. Do you want to have a look at DAX later on, Brian?
Yeah, I can have a quick butchers. I can have a
Okay.
quick butchers. Yeah, definitely.
Dollar Schweiz before we stop. I've been buying of this 61.8 retracement as well. Other people are looking at this possibly forming an inverted head and shoulder. For the time being, it's still holding, so that's the good thing. And I've been legging in and out of this, so my average is pretty cool right now. But I would not like this to get back below this level and hold below. So this is really going to be my level that I'm going to monitor. One could argue 87.60s as well, but I'm not even going to let it go that far. If it shows signs of breaking this 15.20 in the dollar Swiss, I think perhaps it's going to trade a bit lower into the end of the month, possibly, because there's one that is relatively underperforming, and that is the Swiss stock market. This month is not really doing a lot compared to the rest of the stock markets, and that may in turn see perhaps a bit of Swiss buying. But let's see. That's probably for next week. In the meantime, I'm watching this level. Anything else? So Giuseppe, you want to see cat strength? Oh, ergo dollar cat weakens. Okay. All right. Okay. Yeah. If you want to, I think that's the zone there, right? This 136, 40, 65. This is where you want to really measure the strength or weakness. If it starts to break below, then there may be a bigger. Ruble lira, I think it's in a range, Brent. Brian, back over to you, mate.
not with ruble lira, you ain't.
Yeah, ruble lira is in a range. Both go weaker all the time. So
right, okay, let me grab it back quickly. Just have a quick look at the DAX. Richard, let us know what you're doing as well in that, just so we get a bit of flavour as to what you're looking at. It's certainly looking pretty strong. Just take the shorter term moves here. We're coming up towards these big highs up here. So we're into a level now. I had to call that a bounce off the 38.2, if you like, close enough for government workers, Blake would say. You're in a short position. Okay, looking at that, you know where your pain comes in further. If your shorts aren't going to work over, 1,600, that's when you start to, or 16,000, that's when you might start to feel a bit more pain in your shorts. I don't know where you're short from, mate. Hopefully not too far away, so you got some wriggle room. Yeah, I mean, that looks bullish enough. Is this going to be the Santa rally, the year-end rally, and then reality takes over? Who knows? I don't know. But this is looking pretty strong, this move at the moment, considering it's happened basically all month. But yeah, I think you've probably got a bit of a line in the sand here, up at 16,000. If that goes and it starts to build, then shorts isn't probably the best way to be positioned for that. But Giuseppe, rather like a DAX long. Yeah, that may be so. But where you're going to buy it, that's the question. Where do you find a decent enough support area to test it? If you want to come even shorter for a more intraday look, we've had a little bit of resistance up here. What's that? 159.5. That's where support is pretty much coming in at the moment. So if you're long in, that's where you might want to look at. You don't need to be a hero with that. You know, if you're below 159, then that's looking a bit wobbly as well. Same for shorts. I've got out my gold position, purely my gold short just now, purely because I'm not liking the price action. It's looking a bit similar to this, where it's just not giving back anything. So I'm more feeling like this is heading higher in the DAX than it is coming down. So yeah, be careful. That'll be my view. 16,000 is your pain level for that one, Richard. But good luck with that one anyway. And yeah, just to mention, I've just tipped out my gold. I just don't like it. Sometimes I look at something and I think, yeah, I just don't like the look of it. It's not giving back. It's building a bit of strength here. The dips are coming back not very far. It is still it's a decent looking level still up here into these highs, but I'm just not liking the price action. So I'd rather get out for no loss than gamble away. If it goes down, so be it. It'll be a trade missed. Get back on the horse and try the next one. But yeah, it's like similar looking for the DAX. This is that sort of 159.5 area in the DAX, just not coming back below it. Keeps the tops in play. You know, that's the 16,000 level, and I just don't like the price action for a short in this one. So similar to the DAX in terms of price action. How you trade it is up to you, Richards, but good luck for your shorts anyway. Right, on that note, we should call it a day. And thank you very much, as always, for coming to the Flow Show. Thank you very much for Kay and all his valued insight as well. Trade safe the rest of the day. Watch out for tonight into the close. Might see a bit of profit taking, bit of position squaring from those Yanks who are off to have their first Christmas of the year. And good luck to them. Anyway, have a great day, everyone. We shall see you all tomorrow.
Have a good day.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.